today we're covering adjusting entries. And adjusting entries are all about adjusting the accounting information so we bring everything up to date in terms of the information that is reported in the financial statements. So let's start with a simple example. So the example we have here is the electricity meter is read every 3 months. So generally, your service provider will check your electricity meter every quarter and they will bill you for that accordingly. Now, in this case, the meter was last read on January 31, 2019. We received the bill on February 21, 2019 and paid it on March 12, 2019. So the average bill is $600 for 3 months and 4 of us share the house. So the question I have for you now is, I plan to leave on April 15. How much will I owe the others for electricity? So the key information we can see here is that the meter was last read on January 31. So accordingly, you were charged for electricity usage up to and including January 31. You haven't been charged anything from January 31 to April 15. So if one member of the household is leaving, how much do they owe the others in terms of their electricity usage when they leave on April 15? So please answer the following question and let us know what number you believe that to be. So let's break the information down here. As we know, the meter was last read on January 31. So no electricity has been paid for from January 31 to April 15. The bill is $600 on average for 3 months. 4 of you are sharing the house. So that means $600 divided by 4 equals $150 each person. Now remember, I told you the maths in this subject is never going to be very difficult. So if the average share of the electricity bill for each of the housemates is $150 per quarter, then of course that's $50 a month. The quarter, which is 3 months divided by 3 months, is $50 per month. So if someone leaves on April 15, how much do they owe the other housemates so they can cover the electricity bill when it arrives for the following quarter? Well, 2.5 months of time passed from January 31, when we were billed for electricity up to and including, to April 15, right? So we haven't paid any electricity bill that relates to January 31 to April 15. That is 2.5 months of time. So if the average electricity incurred per month is $50 per member of the household, then that means that that member owes $125 to the remaining housemates when they leave so they can cover their share of the electricity they've used up to and including the period they left, right? So they can cover the electricity they use from January 31 to April 15. So now this is assuming that that person that's leaving used the same amount of electricity that everyone else used. And that is a reasonable assumption in most cases. But there was a decision there, and the decision we made there in this case is everyone's using the same amount. Now, of course, if you have a housemate that is using more electricity than someone else, or they are using electricity at different times, then of course they may not have the same share as everyone else. So let me give you an example. If I have a look at an electricity meter, this is what's called a smart meter. This meter sends the electricity that you have used, so information about the electricity you have used, to your electricity retailer. So that could be Energy Australia or AGL or some other service provider. So then they can generate the bill and send it to you for the quarter. Now, what these smart meters typically embed is time of day charges. So that means that if you use electricity in a peak time, you're charged more. So if I show you my electricity bill, you can see here that the peak rate that I'm charged is 41 cents per kilowatt hour during the peak time. And the peak time is from 2 p.m. to 8 p.m. Monday to Friday. So if I have a housemate that gets up later in the day, plays video games on a massive screen TV from 2 p.m. to 8 p.m., they are, of course, going to use a lot of electricity during the peak time, which is going to incur a much higher cost than what it would be in the off-peak time or the shoulder rate period. Okay, so if you're a night owl and you, for example, use electricity from 10 p.m. to 7 a.m. in the morning, you're only charged 11.4 cents per kilowatt hour. And that, of course, is a lot less. And so therefore, if you are a night owl and using electricity at that time, of course, your share of the electricity bill should be a lot less than your housemates. So you could build that into the estimate that we looked at here, and you could arrive at a different figure. Now, this, of course, is a choice, and this is one of the points that I emphasize to everyone in week 1 of the teaching session. There is choice in accounting. Those choices will lead to different numbers for which you put together to report on your financial performance and financial position, and therefore that will lead to better or worse levels of financial performance and associated position being reported about an entity. So there is a lot of discretion when we determine accounting numbers, and when we record adjustments, we're going to build in a lot of assumptions about, for example, resource usage, just like we did here, that will lead to certain expense numbers being calculated for the period. So if we look at today's learning objectives, we have a number of learning objectives. The first thing that we're going to look at is what the difference between accrual and cash basis of accounting is. So accrual accounting is what adjusting entries essentially relate to. We're going to look at the major circumstances in which adjusting journal entries are necessary, and then we're going to consolidate those adjusting entries into our financial records so we can generate our financial statements, and then we'll have a look at what closing entries are all about towards the end of today's workshop.